G'day Gain Squad, and welcome back to the channel where we jump ahead of the pack. Let's get into it. Today we are unpacking the absolute market carnage from March 25th to March 27th, 2026. We are covering the gold correction, the oil volatility explosion, and the massive $8.4 billion tech sell-off. We will also deep dive into the biggest gainers and fallers of March and run a tight technical analysis on gold. Quick disclaimer, this script is for entertainment and general info only, so please chat with a pro before making moves. Now, for the big question, is this the ultimate bear trap for gold, or are we heading for a proper structural reset? Drop your thoughts below, hit that like button, and subscribe to help us optimize this community, traders. Let's look at the geopolitical firestorm that has been rattling the screens over the last 48 hours. Operation Midnight Hammer is in full swing, and the Strait of Hormuz is effectively blocked for international shipping. Tanker insurance has been flat out suspended because of the risk of sea mines and drone attacks in the region. Iran is running a vetting system, only letting friendly nations through the choke point while rejecting US peace offers. But on Friday, March 27th, President Trump gave the markets a bit of a breather by extending a deadline. He has paused potential strikes on Iranian energy facilities until April 6th to give diplomacy one last go. This headline helped gold stabilize slightly after the massive 3% drop we saw on Thursday afternoon. Now, energy markets are on a total rollercoaster, and the volatility index for oil is looking absolutely mental. The Crude Oil Volatility Index, or OVX, has surged past 1 to 100 this week, which is basically double the norm. High OVX means the market is pricing in daily price swings of up to 4.5% in crude. West Texas Intermediate, or WTI, closed at $94.49 on March 26th. That is up over 4% in a single session, as traders worry about a long-term closure of the strait. Brent crude is even higher, settling around $108 as supply chains get proper choked up. Every 10% rise in oil acts like a tax on the global economy, shaving about 15 basis points off GDP. If oil stays above 110 for the rest of 2026, corporate earnings could take a 5% hit. It is a tough environment for anyone trying to pick a direction without getting caught in a volatility whip. Back home in Australia, the inflation data released on March 25th was a bit of a mixed bag for the RBA. The Consumer Price Index for February came in at 3.7%, down a tick from 3.8. Housing is still the biggest pain point for Aussies, with prices up 7.2% over the year. The Reserve Bank of Australia is staying hawkish, warning that the economy is further from balance than expected. They are signalling that our interest rates will need to stay higher for longer to restore potential supply. Don't expect any rate cuts from the RBA until at least mid-2028 at this rate, traders. This sticky inflation pulse is making the Australian dollar's recovery a very slow and painful process. Looking at our currency, the Aussie dollar pair has been struggling against a very aggressive greenback lately. On Wednesday, March 25th, the Aussie dollar was trading around 0.7073, but the rally got cut short at the 50-day moving average, sending the pair back towards 0.6 to 9. By Friday, March 27th, the Aussie dollar was hovering around 0.6893. The US dollar index, or DXY, is currently finding massive support at the 99.0 level. When the dollar is this strong, it puts a massive dampener on risk on currencies, like our local Aussie dollar. Over in the States, the Federal Reserve has essentially crushed any hopes for a near-term interest rate cut. After the March 18 meeting, markets have completely priced out any rate cuts for the rest of 2026. In fact, 38% of traders are now betting on a rate hike by the end of December. Federal Reserve Governor Michael Barr said the central bank needs to keep rates elevated to tackle the energy-driven inflation. This hawkish shift has pushed the 10-year US Treasury bond yield up to 4.416%. High yields are a massive headwind for gold because the yellow metal doesn't pay any interest or dividends. It is a stagflation setup where growth is slowing but prices are staying stubbornly high across the board. Now, let's talk about the tech wreck as the magnificent 7 giants finally start to part ways. The era of these 7 stocks moving in one big happy block is officially over, and the split is ugly. Microsoft is the biggest laggard of the group, down 19.2% year to date. Investors are questioning if Microsoft's massive spending on AI will actually result in real revenue growth soon. Tesla has dropped 14.6% this year as electric vehicle demand continues to soften. Amazon is down nearly 10% as the market loses patience with the high costs of the AI arms race. On Thursday, March 26th, Meta Platforms had a proper shocker, falling over 7% in a single day. Meta is dealing with a nasty combination of legal setbacks, fresh layoffs, and concerns over massive capital expenditure. Apple is also in the wars, down 8.1% in 2026 due to soft consumer demand. Nvidia is actually holding up the best, only down 4% since the start of the year. It seems Nvidia is still viewed as the king of AI infrastructure, but even the king is feeling the heat. Alphabet, aka Google, is also relatively steady, down only 2.3% thanks to its ad business. This divergence shows that traders are now judging each of these giants on their own specific merits. The shared halo that protected these tech stocks for the last 2 years has officially vanished into thin air. We are seeing a discriminating market that is asking very hard questions about immediate pricing power and margins. The Magnificent Seven now represent about 33% of the S&P 500, down from recent peaks. If these 7 keep stumbling, they are going to drag the entire index down with them, no dramas. But here is the real red flag for the smart money, the massive volume of insider selling this year. High-ranking executives and board members at the Magnificent Seven have net sold $8.4 billion in stock. Amazon insiders lead the pack with over $5.7 billion in sales over the last 12 months. Nvidia bosses have also offloaded more than $2.2 billion, while the AI hype was peaking. Not one single insider at Nvidia, Apple, Amazon, or Meta has bought a single share with their own cash. Elon Musk at Tesla is the only exception, with a $1 billion purchase back in mid-September, keeping things interesting. When the people running the show are selling a boatload of stock, it is usually a sign to be cautious. Now, let's do a deep dive into the biggest moves of March 2026, starting with our gainers. WTI oil is the undisputed champion of March, jumping from $65 to over $94. That is a massive gain of over 40% in just 4 weeks as the Iran war chokes supply. Brent crude also surged, touching $119 earlier this month, before settling at $108. This oil shock is the primary driver of the market's current wobbler and the shift in Fed policy. Iron ore has also seen some strength this month, rising 7.1% as supply routes shift. Fertilizer and energy-related commodities are also up significantly due to the transit disruptions in the Middle East. While these gainers are printing money for some, they are creating a massive inflation headache for the rest of us. Most energy ETFs have seen returns between 31 to 100% since the start of the year. If you are positioned in the old economy energy sector, you are likely having a proper golden month. Now for the fallers in March, and it has been a total dog's breakfast for the precious metals sector. Gold is down a staggering 17% this month, its worst performance in over 4 decades. Spot gold hit an all-time high of $5,589 in late January before the March crash. Silver is in even worse shape, crashing over 27% in March as speculative positions got flushed. Platinum has dropped 23%, and copper is down over 9% as global growth concerns mount. The S&P 500 is down about 4% this month, struggling to stay above its 200-day moving average. It is on track to finish the first quarter in negative territory, which is quite rare for the index. History suggests that a rocky start often leads to a strong rebound, but the current headwinds are very stiff. We are seeing a flight to liquidity, where investors sell gold and stocks just to raise immediate cash. When markets get stressed, smart money sells what they can, not just what they want to offload. Our local ASX 200 hasn't escaped the carnage, falling over 8% in the last 30 days. On March 26th, the ASX hit 8,447, its lowest level in over 10 months. Heavyweight resource stocks and banks are dragging our index dangerously close to an official bear market. The tech-heavy Nasdaq is officially in correction territory, down nearly 10% from its recent October peak. Every single one of the Magnificent Seven is in the red this month, with Microsoft leading the way down. Even Bitcoin has taken a haircut, trading around $68,000, well below its previous highs. It is a broad-based liquidation that is hitting everything from tech to digital gold and physical bullion. Traders are looking for any sign of a bottom, but the macro tape is currently very tight and restrictive. With the Strait of Hormuz still blocked, the risk of a stagflation recession is becoming a real conversation. Don't sweat the dip, just more room in the pouch, as long as you're not over-leveraged in this mess. Investor sentiment is pretty gloomy right now, with Jim Cramer calling this a forced liquidation event. Cramer says the sell-off in stocks is being triggered by commodity traders who are facing massive margin calls. He warns not to listen to the Jeremiads of destruction and to look for long-term value in the dip. On the flip side, Ed Yardeni thinks the great valuation rotation is just getting started for the Roaring Twenties. Yardeni still sees gold hitting $6,000 to $1,000 by year-end as central banks keep loading up their reserves. Major banks like JP Morgan and Deutsche Bank are also staying bullish on gold for the medium term. They reckon the structural case for gold, like de-dollarization, is still fair dinkum solid despite the price drop. In fact, de-dollarization is accelerating as BRICS nations move to resource-backed trade to bypass the US dollar. Now for our 8 rows of technical analysis. Gold is currently trapped in a steep descending channel. The Relative Strength Index, or RSI, on the daily chart is at 40.4, signaling a strong sell. On the 1-hour chart, gold is forming a bearish rising wedge, which suggests another leg down might be coming. Major resistance is at $4,000–$6,000, a level that has rejected every bounce attempt this week. The next big support floor is at 4,311, the 61.8% Fibonacci level. Below that, the critical 200-day moving average is waiting at $4,200 an ounce. The MACD is negative at 0.3 to 6, confirming that the bears are firmly in the driver's seat. Bollinger Bands are expanding with high volatility, so expect some proper price action in the next few sessions. To wrap it all up, gold is struggling under the weight of high interest rates and a surging US dollar. Oil is the clear winner of March, but it is causing a massive inflation headache for the global central banks. The Magnificent 7 tech stocks are splintering, with insiders offloading $8.4 billion in shares. Australia's inflation is still a bit sticky, meaning the RBA is going to keep our rates higher for longer. Geopolitical tensions in the Middle East are the main driver, with Trump's new deadline offering only a tiny relief. Technically, gold needs to break 4,600 to turn bullish, otherwise the 4,200 test is on. Smart money is rotating away from expensive tech and into old economy sectors like energy and commodities. So traders, what's your play? Are you buying this proper golden entry or waiting for more blood in the streets? Let us know in the comments if you think the gold bull market is dead or just taking a breather. Smash that like button if you found this helpful and make sure you are subscribed for the next market update. Stay active, stay legendary. Catch ya.